This is Kevin Donahue, Senior Director with Protiviti, welcoming you to another edition of Powerful Insights and the latest episode in our transformation series focused on the future of risk and compliance. Today's discussion focuses on the current and future state of risk analytics, which is bedrock to empowering the compliance function's forward-looking agenda. With a perspective of the evolution of enterprise risks, advancements in analytics, and the ever-morphing regulatory landscape, compliance can be transformed by being further data-driven and monetizing the deployment of advanced analytics and empowering intelligent decision-making and risk detection. In this episode, Protiviti Managing Director Constantine Boyadjiev interviews Griselda Rondon from KeyBank and Harsh Singhal from Wells Fargo. And now, let's go to their conversation.
Welcome, everyone, and thank you for joining us as part of our ongoing compliance transformation series. I am Constantine Boyadjiev, a Managing Director leading Protiviti's Global Risk and Compliance Analytics Solution. And today, I've got the pleasure of being joined by two very forward-thinking leaders in the field of risk management, analytics, and compliance, namely Griselda Rondon, who is the Chief Model Risk Officer and Head of Analytics Oversight at KeyBank, and Harsh Singhal, Head of Decision Sciences and Artificial Intelligence Validation at Wells Fargo. We will be discussing how financial services firms specifically can embrace change and harness technology, all while bringing innovation in fields of analytics, risk, governance, and compliance. Additionally, we will share insights on top priorities, upcoming challenges, and any headwinds, and the opportunities we foresee in risk analytics and compliance leaders facing in the transformation space today. Griselda and Harsh, thank you very much for joining me today. And to commence, can each of you please share a bit about yourself and your path to your current career and leadership position? You know, maybe Griselda, starting with you.
Okay, great. I've been here in the United States for over 20 years now. Actually, in the United States, over 30 years, and working on quantitative analytics for over 20. So I'm original from Venezuela. And when Venezuela was a very strong country, I won a scholarship to come and do a PhD here in abstract algebra, which I did. But then at the time that I was finishing my PhD, it was about the time that people started talking about Basel II, etc., and ways to calculate capital, more refined, etc. And then, of course, every bank was jumping on how we do that and which are the skills we need. And the skills were people with formal math background. So I found my way. I thought that was so interesting, and I like to try that. And even though I did abstract algebra, which didn't have anything to do with banking, I was given the opportunity. I was hired, and by KeyBank, I given the opportunity to work with them and start learning finance and how to apply the math. I also knew a lot of statistics by that time, so how to apply all of that to a specific problem. So I had a great experience at Key. They really helped develop my skills, and I learned a lot about banking and finance. So, my evolution, I grew up from being an analyst, an entry-level analyst, to be the Chief Model Risk Officer at KeyBank. So it has been a very rewarding path and a great experience.
Terrific. Harsh, over to you for your quick blurb and background.
Thanks, Constantine, and thanks for having me on. Like Griselda, I grew up outside of the United States. I actually grew up in India. Unlike Griselda, though, I didn't do any abstract math. I think I did one course in abstract math, which was mostly on a dare, and I managed to pass it. But in college, I actually majored in electrical engineering, and I developed a very strong interest in probability and applied math. So I decided to pursue a PhD in statistics and went to University of Michigan Stats Department, which was unusual in having a very, very applied focus. So my research work there was focused on statistical problems related to internet infrastructure and medical imaging. After PhD, I joined the financial industry and worked on model development for strategic planning models, capital planning models, CCAR models, and some deposit modeling. Couple of years ago, I moved from model development side to the model validation side, and also moved a little bit away from financial models to mostly non-financial use cases like marketing, underwriting, fraud detection, financial crimes detection, fair lending, artificial intelligence, including chatbots and compliance-related applications. Now I live in San Francisco with my wife and 2 daughters, and we like to spend our free time going on hikes and watching animated movies with our kids.
Terrific. Thank you both. So we could see that data and analytics certainly is the kind of common thread and central magnetic force, somewhat similar to you guys. While I'm born and raised in the US, I grew up in Europe. So here we are, 3 risk analytics professionals representing as many continents and having kind of that central unification force. So thank you both for your background. As the topic of the podcast is the future of risk analytics, I felt it only feels natural for us to actually take a bit of a backward look into the past. And maybe you could comment through each of your individual perspectives as seasoned risk analytics leaders and professionals. Can you comment what drivers, dynamics have shaped and gotten us to the current state in our risk analytics field? As you reflect perhaps on past experiences, in your professional growth and rise to stardom, what are some salient factors or inflection and pivot points that you've seen over the last, call it, couple of decades that you feel have shaped our risk analytics arena of today?
So, I think that it's part of a normal evolution. So I think is the drive, the motivation there is always, to be competitive in the market, to how we better understand our clients, how we can have more segmentation, more differentiation. And the truth is, you see the motivation of using models and hire people like us inside banks is because you need that level of sophistication. That is the way I came in KeyBank. It was at the beginning, we want to have good models for probability of default. Nowadays, we want to understand our clients better. We want to be more targeted, etc. So I think that the motivation is there, and then that strike, like they gather more and more information from our clients. So we want to understand them better, and we also want to know more about them so that we can be proactively helping them. That's another thing about bank, is not just managing the risk right now. Now we also want to empower our clients and give them hints of how they better can manage their resources. So all that prompted of gathering more and more information about our clients, and of course that also the increase of the capacity to process of that information. It is what has created this focus on analytics right now. That's what has created analytics now are part of the strategic thinking, and for the leaders in the bank, for our senior leaders, they talk about that. They talk about, what are we doing and how can we leverage the knowledge that we have to be faster, more competitive, more automatized, more effective, etc.
So, I joined the financial industry in 2008, so I don't quite have two decades of experience. But, a large part of my career in finance was shaped as almost like an aftermath of the great financial crisis. And it was certainly a huge inflection point. And frankly, it could be seen as a little bit of a failure of risk analytics to live up to its promise. So, in response, we see a series of big changes in the world of risk analytics, especially the financial risk analytics world, with starting with CCAR and then moving through the various twists and turns in risk-based capital. There's been some interesting developments there. Then we had CSIL for allowance, and then a bunch of changes in market structure and products, continuing even today with the LIBOR transition that a lot of banks are going through. So all of that has been happening. And in the meantime, banks are facing a lot of pressure from the low interest rate environment, as well as competition from fintechs. And this is particularly important for the compliance area, right? Because compliance is not quite a revenue function. And also, we don't really see a perfectly level playing field with the fintechs. So, risk analytics needs to evolve with the times. First and foremost, it needs to fight against a sense of complacency, right? It's been awfully quiet in terms of big risk events. Risk analytics also needs to adapt to agile approaches and stay abreast with technological change. And now, we are in the middle of a global pandemic, right? And which first and foremost, it's an incredible human tragedy. But in terms of risk analytics, we didn't really, as the financial industry, didn't really experience the same kind of pain from the pandemic as it did during the global financial crisis. But some of the ripple effects of the shock will probably be as important as a financial crisis is for the financial industry, and I think all of that remains to play out.
I had to say I like your last comment because it also shows and the evolution and the maturity. I think that we see the impact of some of these regulations that has been so criticized, like SR 11.7, but I think that it proved to be useful because a lot of people are reporting right now that they knew how to take care of the models and how to quickly establish controls, etc. So, yeah.
Thank you both for your perspectives on the evolution of risk analytics. If, I think the saying is appropriate here that if there's one constant, that's really change, as we've seen it through evolution. And in fact, that leads me to my next question of, looking ahead this time, what are some, emerging trends or driving factors or, pivotal forces that you're seeing that, can further shape somewhat the risk analytics agenda of tomorrow?
So, I know we'll talk about AI and RPA and things like that a little bit more. So I'll hold off on that. That's obviously an important trend. Other than that, I think, some of the developments in cryptocurrencies and innovations in payments, they seem pretty important, and, they should be top of mind for everyone. We are obviously at a point where there is near universal adoption of smartphones. Everyone has this incredible computer in their pockets. We're seeing sort of huge adoption of digital banking, and I'm sure we'll start seeing a greater move towards ideas like virtual reality and open banking. So these are all very, very important trends that have a direct impact on financial firms. I think there are also sort of broader trends in society, like, all the aftershocks that are going to come from the pandemic, rise of China, as well as, here in the United States, the polarization of society due to information bubbles. It just makes it very hard for all firms, but particularly financial firms, to sort of navigate the political climate. So, exactly what these impacts will be is hard to say, but certainly we can expect some impact.
I will say that, that the most impactful to us, of course, is COVID, and there is still a lot of uncertainty about that. So, you need the analytics to inform the path. Also, the digitalization, that digital banks, and, have making sure that, as I said before, that we get the benefits of that data by understanding better our clients, but also by being proactive and helping them better manage their finance. So in all of that, what I have seen internally, I wanted to say, so how the cultures are changing so that we can face all these trends or challenges or opportunities that are occurring and are hitting us. So I see that, in the past, you could afford probably to have silos and have a model build, among a small group of people. But what I see and what we're trying to do, and one of the biggest focus is to have cross-functional team tied to a specific task. so that there are specific questions we have from the business that need a cross-functional team. So culturally, there is also this change of mentality. We are partnering together with this one common goal. We need to solve this problem because that will really empower our digital bank. And in that cross-functional team, you will see, the model validation, people from IT, you will see people from technology, people from the business, the developer, the data science, etc., all coming together with this one record. That sometimes we remove people from where they are, their projects, and we form a cross-functional team just to work on that. So institutionally has been a change in culture, the idea that this is the way we're gonna achieve our goals. There is also, being a model validation, there is always this question. I was even in a roundtable very recently, somebody said, how can we do anything if we have to deal with model validation? And this is part of the changing culture. Like, how can model validation be seen more as, we are part of the bank too. We are a trusted stakeholder. We are there to be part of the solution. We're not gonna come with a hammer. How we change that culture, that we integrate model validation still with independence. And this is what I see at least happening inside my institution. There is a change of culture. There is this idea that analytics first type of mentality, and it's just happening, and I think is part of the same evolution that we see.
Thank you both, Griselda and Harsh, for your perspectives. Indeed, as I'm thinking of today's world and present reality, certainly in the pandemic, we used to associate the younger generation to us being digital natives, quote unquote, and we have all become digital natives currently. We have to, right? When was the last time we walked into a bank transacting in physical form recently? To Griselda's and Harsh's point on the digitalization and data, all of a sudden, we've got potentially even more augmented intelligence by looking at user behavior during sessions, device profiling, various amount of data elements that can further augment a lot of the intelligence, whether it's for threat detection or behavioral analysis. Maybe a good foray into this topic, since we're looking ahead and talking about emerging trends in technology, there has been significant amount of discussion and traction around adopting anywhere from advanced analytics in the AI and machine learning spectrum to robotics and process automation. As we look at these novel technologies and the fairly rapid adoption of such, what are both some tailwinds as well as headwinds that you both, Griselda and Harsh, see? As you reflect on that, if there's such a thing as a good example of what that looks like for an institution that is rapidly adopting these new technologies in this arena, what would that look like? Maybe Harsh, starting with you.
Yeah, certainly. I mean, it's a topic very, very close to my heart. And, I think even before we get into AI ML, it's important that a firm has a very strong foundation of well-structured processes. Because, these are all tools that support processes, right? So the processes need to be well structured, and they need to be structured in a way that they generate valuable data. And then, the technology should be well engineered. The system should be well engineered that they make this data available timely and conveniently for analytics, right? So even if there is no AI ML, having that foundation is critically important. Now, once that foundation is there, AI and machine learning can really boost the value of risk analytics and its effectiveness as well. The one really critical question all firms will need to answer is, who is actually going to do the heavy lifting of building the infrastructure to enable adoption of RPA, AI, and ML? And, first firms need to have a way to attract some key talent, and make sure that senior leadership is empowering that talent and the technical teams. But having said that, there is no way the financial firms are going to build everything in-house, right? I mean, even with the best talent, it just doesn't make sense for financial firms to build everything in-house. So they will end up having to work with third-party providers. And there's just so much out there in the ecosystem. It's a very dynamic ecosystem. And so firms will need to become really, really good at making decisions about third-party providers. And if you get it wrong, it can really, really hurt the organization. But if firms can get that right, I think that really is a force multiplier for firms.
From my perspective, I think that, we have already there are a lot of uses of these techniques that, are helping institutions be more efficient. One of the things that makes me more excited is to see people spending more time thinking and doing analysis that rather than filling up a form or saving some documentation in the appropriate places. So for example, one of the uses that was very, very helpful to us was identifying all these contracts that were LIBOR impacted. So that was an ML that was built, and it helped us be a lot more efficient that way, etc. So I think that we already, nobody will negate the benefits of these. But I agree with Harsh that, to get the full potential of these, you have to work on the right infrastructure. I think that, an operating environment that will allow for, the connectivity of the data, the appropriate a tool to be used, some level of standardization so that we can streamline governance. I think that these are all difficult things to solve for, because, as you say, who will do these? But also, if you don't, inside my organization, there is not a centralized analytics team. There are two major analytics teams, so there needs to be some alignment among these teams, and also find the talent to work with us to do all of this. But for me, what I'm most focused right now is in creating an operating environment that will allow the streamline of the governance. So I don't have to hear anymore that validation is getting in the way, but also the connectivity of the data that will allow us to have this holistic view of our customers. Those are one of the difficult challenges that we have to overcome.
No, absolutely. And we're seeing that across clients and frankly industries as well, right? With the rapid adoption, AI and ML is the buzzword, but if you don't have the infrastructure, including data, technology, human capital, governance, right? It'd be an uphill battle to be able to really be more than just aspirational. And to maybe that end, just staying on the topic of, use of AI, there's a lot of stories that we've heard and read of somewhat AI gone wrong, where for, of course, unanticipated consequences, some of these AI algorithms have been tainted, whether, the data that's been used was tainted, the proxy for data was also one, but we've heard, headline stories anywhere from, credit underwriting decisioning kind of gone wrong to fair lending implications, even employment application screening. Given that AI and machine learning, often by design, is fairly opaque and intransparent, by its very nature, it could lead to, unforeseen effects, potentially introduction of unintended biases. And as such, the regulatory scrutiny has rightfully so increased, specifically around the responsible and ethical use of such and the need for explainability. You as both, leaders in the risk analytics arena, what are some of the top things that, you and your organizations are thinking about to kind of help ensure that your organizations, remain compliant? And again, AI and machine learning is, to the extent possible, explainable, used in an ethical and responsible fashion. Maybe starting with you, Griselda.
Yes, so for me, these techniques, these are just the quantitative techniques. They're more sensitive to the data. So I think that, the focus is on that data. So do you really have the appropriate data? The process of analyzing the data, understanding if you have enough to apply one of these techniques is very important. I think that the problem and all these bias problems somehow were easy to recognize because it was the data that was not appropriate, not the technique. The technique is fine. I mean, but this technique is more sensitive to extract information from the data, so it will extract the bias if the data if the bias is there. In relation to, so we are very careful to make sure that when we are validating models that we understand the data very well and that we run different type of tests to ensure that the data doesn't have a bias. In relation of the explainability of the model, and bias analysis can be done also at the end once the model is built. In relation to explainability, it depends. So not all the machine learning techniques are things that you could not explain easily. Some of them are. But I think where we focus is in the use. So what is the use that you have of that technique and what level of explainability is required? Because I think that, there are many techniques that have been proved very helpful around fraud, around money laundering, cyber, that, that I don't think that we'd go so much for the level of explainability. We will want to understand the front end of how the model was conceived and what data was used, and maybe focus a little more on performance. So I will not spend too much time thinking about the explainability of those models. But of course, if we have models that are using machine learning techniques and for example, right now there is a trend to use different data types to be a little more proactive in identifying risk of our customer, whether it's a commercial or a consumer customer. Then that is different, because in there we have to understand how this model is making a decision. So I have to say I have not seen a lot of that. There is a lot of in the pipeline. So right now, like testing this type of techniques, but they're not being used just yet. Within our institution, more of what I see right now is in cyber fraud and money laundering.
Yeah, and Griselda covered it really, really well. The one additional point I want to highlight is, you have a range of options here, right? And you want to make risk-based decisions. So, machine learning and AI does not have to be opaque. Does not have to be non-transparent. When people say AI in the context of financial services, they are typically talking about three different things. One, they're talking about alternative data. Two, they're talking about ML ops. And three, they might be talking about the ML algorithms. And these are actually three independent levers, and you can pick and choose. You don't have to do the whole thing all at once, and you can decide how far you want to go in each dimension. Alternative data that includes unstructured data, it adds a lot of value, but it also introduces a significant risk of bias. So that's where you have that trade-off between a lot of potential performance gains versus a lot of potential for bias as well. ML ops is basically just using the best technology for developing and deploying models really, really fast, including potentially dynamic updating. I think it's hard to get ML ops right due to the scarcity of talent and how new the technology is. And dynamic updating introduces some risks of its own, some unique risks that come due to dynamic updating. For example, the increased risk of adversarial attacks. ML algorithm, the third piece, is where transparency issues come in, right? And there is a bit of a, I think, urban legend that there is some sort of a performance transparency trade-off when it comes to machine learning algorithms. In many cases, that simply may not be the case, right? In practice, there are interpretable machine learning techniques that give very transparent models, and they have effectively the same real-world performance as a black box machine learning technique for most of the common use cases. So in other words, the black box machine learning algorithms, they introduce a lot of risk, In fact, they kind of act as multiplier for the risks that are coming from alternative data and dynamic updating, but they probably don't provide enough benefit to justify the risk. So, when it comes to the most critical use cases where there is the biggest risk of adverse impact to customers and employees, firms should really look at only using interpretable machine learning algorithms.
Yes, absolutely. Griselda and Harsh, thank you both. And to offer maybe just our experience, having dealt with a lot of your peers and cross-jurisdictional regulators, and to your collective points, Harsh and Griselda, not everything, just because it's AI and machine learning based, means it is labeled as a black box or non-transparent and opaque. Regulators have realized that as well, and they're also looking at what are the use cases that these technologies are being applied to. For example, we have instances where if artificial intelligence and machine learning is applied for things that I call intelligence augmentation rather than necessarily decision making, then even that level of explainability may not need to be all that deep or thorough. You're not necessarily acting on it in terms of, say, credit, underwriting, or any other form of decisioning. So it really depends on the use cases, but to both of your points, Griselda and Harsh, it does not by definition mean that everything in AI and machine learning is necessarily non-transparent and opaque. And you just see an end result without having a bit of explainability or audit trail.
I like the point also that not everything that is AI or ML is better, because sometimes you find that people have tried traditional techniques and they claim the ML is better, and it's because they're just using a lot more data. So of course, if you informing the model more, it will do better. Yeah.
Indeed. So my penultimate question, let's talk talent, since both of you guys had mentioned the key importance of it. So regardless and agnostic of industry, we're seeing, clients express somewhat a demand for analytical talent that we're somewhat all after, right? It's a bit of a fierce war for talent where the type of skill sets that are being needed, are kind of a Venn diagram of many circles: data science, data engineering, business intelligence and digital storytelling, deep subject matter expertise across a number of domains. So in both of your respective roles as, having a leading say in shaping your institution's forward-looking human capital and analytics agenda, where does some of that talent fall in your priorities, and what steps are you taking in both discovering such in nurturing it?
Yeah, Constantine, I think you hit it on the head, right? I mean, talent is absolutely critical. It's just a fierce competition for talent going on, and it's a critical deciding factor in the success of any analytics agenda. In terms of finding talent, we have some very robust early talent programs, including internships, university collaborations, and rotation programs. We also allow our team members a lot of opportunity to publish and present in conferences, which actually creates a very positive feedback loop. I actually found one of my managers in a conference, right? And you kind of meet people, and it just is a great way to attract talent.
So I have a similar answer, actually. I think all those roles, data engineering, data science, and data storytelling and subject matter, they all need to be, they're equally important. Those roles are needed so that you actually can have a successful analytics outcome. And the way we handle that, and, very challenging environment to hire people right now, and it has always been in this space, but right now people working remotely, there is that flexibility has been the challenge to be a lot more difficult than it was in the past. So that what we are tackling is that there is a prioritization. What are the answers the business wants to have? We are a middle-sized bank, so we go into prioritizing that, identifying what are the things that align with the strategic priorities that KeyBank has. once we identify what are the answers that we're looking for, because and align with these strategic priorities, we ensemble confrontational teams that come across different parts of the organization, and they're tackled against these different projects. So I have people in my team that probably will go into that direction for a short time, that really, like you could say 3 months, between 3 and 6 months, they will be completely immersed into this process until that project stand up and we have something that we can start testing. Also, we're going at this problem in an agile way, so not looking for perfection, but looking for the minimum viable product that we can have, that we can start piloting and start perfecting, and then we get where we want to be. So we have that process, but we also have rotations among the banks so that we can start building those skills. This new environment has brought the analytics team very close to the technologies team, which is just something new to us. We were close to the data people because we needed, and we were checking the data, but close to technology. That is the new things, because this technique of AI and ML are also look at software sometimes more than models. So we need to work very close to that and sensitize them also around what is the risk of these things that are software part models too. And we partner with third parties, and we bring external expertise for some special situations so that our teams can gain some skills or knowledge transfer from partnering with external parties that has some type of expertise in different areas.
Great. No, thank you both for your perspective. Indeed, the war for talent is fierce, as we're seeing, not even just within financial services. Like, recently we spoke to an internal audit department, third line of defense, where there were some hardcore, data scientists there. And, just probably years ago, you wouldn't have expected necessarily that level of expertise to reside there. And certainly, across industries, these are somewhat very fungible and sought after skills. So my last question relates to, other than the human capital and talent build out topic of, what are some other priorities, both challenges and opportunities that you see in our space? For example, obviously we've got a new administration, which with a lot more somewhat regulatory focused and heavy agenda. How do you foresee some of that shaping? A lot has been said and discussed and will be along the lines of, climate change, and how does that affect, credit and risk decisioning? So what are some of the top priorities, both challenges and opportunities you foresee? Maybe starting with you, Harsh.
Yeah, I think it'll be very interesting to see how the volatility from all the pandemic-related stimulus plays out, right? I mean, it's playing out certainly in the financial markets, but it could potentially play out in the consumer loan and commercial loan area as well. So we need to keep an eye on that. I expect, there'll be greater interest in consumer protection issues. And so, certainly the compliance teams should be looking at it if they're not already looking at it very closely. And then, climate change and cyber attacks, these two seem like risks that are definitely on the horizon. And I assume that related risk events from both climate as well as cyber will just keep getting more frequent and more severe with each passing year.
So I have a similar answer. I think climate risk is something that every bank is started to think about it already and approaching, and is that how we handle this, so that in what part of the bank does this fit and how can be standard up. It is important. The impact of COVID is still lingering there. We have to actually see how it will materialize, because it's when we think that we understand what path is, things start moving again. So I see that as a risk to I see also, COVID left off with an amazing experience. I think it accelerated our understanding, our knowledge of what we can do without being face to face, right? Remotely, digitally. I think that there was a change of paradigms and there was an acceleration in that process, but that process it will bring a lot of challenges. And, fraud, for example, the frauds people are in steroids and they're very inventive. So we have to keep to make sure that with all the regulations that we have inside our institution, we still also can be ahead of the curve, ahead of all these bad people. Same thing on money laundering. So I think that, those are the areas that have my focus right now. I see a lot of challenges. I see all of these new techniques could be very helpful, but then there is the challenge of the data. So that is what I'm thinking of. COVID left us with all this knowledge, but this different way of interacting with each other is bringing us to an arena that we don't really understand completely, and that will be our challenge going forward. So I also have a passion, beside model risk, I have a passion for operational risk. So this is part of the things that I think in the combine.
Indeed. And I could echo that. And, all of us have a number of passions. And, you mentioned fraud and abuse, and that happens to be one of mine as well. And sadly, with the pandemic, we've seen an uptick of that. And frankly, I hate to use words like virality and contagion during a health pandemic, but unfortunately, that's been also the nature of, fraud, abuse, and just risk dispersion. We mentioned a war for talent. Sadly, a lot of these somewhat criminal-based cohorts are also well-funded, and they themselves go after brilliant, data scientists and analytic thinkers. And certainly we've seen recent events with the increase in cybercrime and ransomware and others. So really appreciate both of your perspectives. Well, this brings this exciting episode to an end with the topic of the future of risk analytics. Thank you very much, both Griselda and Harsh, for joining us today. Your valuable insights, perspectives, and thoughts. Stay well and look forward to better times when we could not only just do podcasts, but also converse in person and talk about the exciting days ahead for our field in risk analytics. Thank you both so much and stay well.
Thank you.
Thanks for having me.
Thank you for joining what I hope you found to be an informative conversation between these three leaders about risk analytics and the future of compliance. You can hear other podcasts in our Transform Risk and Compliance series, as well as other topics and insights from Protiviti on our Powerful Insights podcast feed, where we encourage you to subscribe and to review us wherever you get your podcast content.